Your retirement fund crashes approximately 14 times every trading day. Not per year, per day. You never see it. Regulators usually do not either. In the first video, we examined how AI systems learn to collude without communicating. Today, we are looking at how those same systems behave during market stress. This is published research in scientific reports analyzing billions of trading events. By the end of this video, you will understand how these invisible crashes happen, why systems that stabilize markets under normal conditions become destabilization mechanisms during stress, and how AI amplifies these dynamics. 3 parts: the mechanism, the amplification, and what you can actually do. May 6, 2010, a single automated sell order for 75,000 E-mini S&P futures worth $4 billion triggered a cascade that erased $1 trillion in market value within 30 minutes. The Dow plunged almost 1,000 points. Blue chip stocks like Accenture briefly traded at 1 cent. By the close, most prices had snapped back as if nothing happened. If you had retirement savings in the market that day and checked your account at the wrong moment, you might have seen your life savings cut in half, then mysteriously restored hours later. No fundamental news explained it. The CFTC and SEC joint investigation revealed what happened. High-frequency traders initially absorbed some selling pressure, but as the order continued executing, they reversed course and sold aggressively, withdrawing from the markets in the face of uncertainty. Translation: the market makers who normally catch falling knives all dropped them at once. When intermediaries who absorb imbalances all step back simultaneously, even modest shocks become catastrophic. If flash crashes ever felt random, subscribe. This series maps the hidden mechanisms. Regulators implemented new circuit breakers. Exchanges updated systems. Everyone assumed this was isolated. But when I started digging into the research, I discovered the 2010 flash crash was not an aberration. It was just the most visible example of something that happens constantly. In 2013, researchers led by Neil Johnson published a paper in Scientific Reports that fundamentally changed how we understand modern markets. They analyzed trading data looking for flash crash events at very short timescales, measured in microseconds and milliseconds. The finding was shocking. This is not one freak event every few years. It is a background process that happens constantly, at timescales beyond human perception. Most events involve individual securities or small groups of stocks. They happen too fast to trigger market-wide protections. The visible catastrophic crashes we hear about, they are just extreme outliers of a continuous process. The 2015 ETF flash crash demonstrated this pattern at scale. August 24, 2015. Exchange-traded funds experienced extreme price problems. The iShares Core S&P 500 ETF fell 26%, while the underlying index declined only 5.3%. 1,278 trading halts across different securities. Think about what this means for an ordinary investor. Imagine you decide to rebalance your retirement account on the morning of August 24, 2015. You log in around 9:45 a.m. You place a market order to sell some of your S&P 500 index ETF. You are doing everything the conventional wisdom tells you to do. Your order executes during the chaos. Instead of getting something close to the index value, you sell at a 20% discount because the ETF pricing mechanism broke. By the afternoon, prices have recovered, but your shares are gone. You locked in a loss that had nothing to do with the actual value of the underlying companies. The plumbing failed while you were using it. That happened to real people with real retirement savings. High-frequency trading systems provide liquidity under normal conditions. When you want to buy or sell a stock, HFT firms are often on the other side. They buy from sellers and sell to buyers, profiting from the tiny difference between bid and ask prices. This spread captures their compensation for providing immediacy. But HFT firms maintain near zero inventory by constantly buying and selling. When conditions are normal and predictable, this works perfectly. Low risk, high volume, consistent profits. During market stress, this system undergoes what physicists call a phase transition. Water behaves as a liquid at room temperature. Molecules move freely. The substance flows. Lower the temperature enough. It becomes ice. Rigid structure. Completely different properties. Same molecules. Fundamentally different behavior. HFT liquidity provision undergoes an analogous transition during volatility spikes. Under normal conditions, algorithms provide continuous two-sided markets, buying and selling with narrow spreads. When volatility exceeds programmed risk thresholds, the algorithms flip to self-preservation mode. They withdraw bids and offers, widen spreads dramatically, or shut down entirely. This is not malicious. It is rational risk management. HFT firms operate with thin capital buffers and use high leverage. A single bad day could eliminate their entire equity. So when market conditions become unpredictable, their algorithms are programmed to step back. The problem, when everyone steps back simultaneously, liquidity vanishes exactly when it is most needed. The August 2015 ETF crash showed this pattern clearly. As volatility spiked in pre-market trading, HFT firms that normally provide continuous pricing for ETFs pulled back. With reduced liquidity provision, even moderate selling pressure created massive price dislocations between ETF market prices and net asset values. This created arbitrage opportunities that should have been corrected instantly. But the arbitrage mechanisms themselves depend on HFT participation. When HFTs withdrew, the correction mechanisms broke. Prices diverged wildly from fundamentals for extended periods measured in minutes, not milliseconds. By the time liquidity returned and prices normalized, individual investors who executed market orders during the chaos had locked in devastating losses that bore no relationship to actual asset values. The infrastructure failed under stress. Subscribe for the next video where I expose black box strategies. After the 2010 flash crash, different jurisdictions implemented different solutions. The United States installed single stock circuit breakers that paused trading when prices moved too quickly. The European Union created MiFID II with algorithmic trading requirements including kill switches and testing obligations. Asia implemented varying approaches across different exchanges. These inconsistencies created opportunities. During the 2015 ETF crash, liquidity fragmented across venues with different rules. Some exchanges halted trading while others continued. This venue fragmentation amplified price dislocations rather than containing them. ETFs that trade on multiple exchanges saw wildly different prices simultaneously on different platforms. Coordination problems go deeper than rules. Different regulators collect different data using incompatible formats. The consolidated audit trail that was supposed to provide comprehensive U.S. market surveillance faced years of delays and still does not cover all markets. European regulators lack real-time access to trading data across member states. Asian markets operate with minimal cross-border information sharing. When flash crashes involve globally traded instruments, no single regulator sees the complete picture. The May 2010 event involved E-mini S and P futures on CME, cash equities across multiple exchanges and options markets. Reconstructing what happened required months of interagency coordination and data reconciliation. The fundamental problem. Financial technology evolves on timescales measured in weeks or months. Regulatory coordination operates on timescales measured in years. Algorithmic systems achieve new capabilities and deploy them across global markets faster than oversight mechanisms can adapt. By the time regulators document one type of market failure and coordinate solutions, the technology has evolved to create different failure modes. I'm not telling you this so you panic and sell everything. That usually makes things worse. I'm telling you this so you understand the system you are inside of and can ask better questions. The people managing institutional money often do not understand these dynamics themselves. They rely on assurances from technology providers about system resilience, without examining the actual mechanisms. Having this knowledge gives you leverage in conversations with advisors. It allows you to evaluate whether your portfolio has exposure to liquidity risk during stress events. Let me show you what to look for. Here is something that genuinely unsettled me when I discovered it. Sarah Breeden, executive director at the Bank of England, warned in October 2024 that AI trading models might be learning to profit from causing volatility rather than just reacting to it. The mechanism. 10 major institutions deploy algorithmic trading systems trained on similar historical data using similar machine learning architectures. None of these systems explicitly coordinates, but they learn to recognize the same patterns as optimal trading opportunities. When market conditions trigger those patterns, all 10 systems execute similar strategies simultaneously. This creates exactly the correlation that amplifies small disturbances into large crashes. It is the collusion mechanism from Video 1 applied to crisis dynamics. The algorithms do not need to communicate. They arrive at correlated behavior through convergent learning on shared data. The implication: as more capital deploys through AI-driven strategies trained on similar datasets, the correlation increases. The potential for simultaneous mass exits during stress grows. And because these are learned behaviors rather than explicitly programmed rules, they are harder to detect and regulate. The systems appear to operate independently while exhibiting coordinated behavior during the moments that matter most. Two questions to ask fund managers handling your retirement accounts. First question: do you use algorithmic trading strategies? If yes, how do they behave during market stress? Specifically, do the algorithms reduce position sizes or withdraw from markets when volatility exceeds certain thresholds? Most managers cannot answer this with specificity because they do not understand their own system's stress behavior. Second question: what percentage of the portfolio holds securities that trade primarily through algorithmic market making? If significant portions are in instruments that depend on HFT liquidity provision, you have exposure to phase transition risk. Can the manager explain how the portfolio would be affected if HFT firms simultaneously withdrew from markets during a stress event? If your advisor dismisses these questions as irrelevant or overly technical, that is your answer. Opacity is not sophistication. It is a warning sign. The professionals managing institutional capital should understand the infrastructure their strategies depend on. If they rely on assurances from technology vendors without examining actual system behavior during stress, they are not managing risk. They are hoping risk does not materialize. Let's take a breath. There is a specific type of anxiety that comes from realizing the plumbing of the market is broken. You do exactly what you are supposed to do. You dollar cost average, you diversify, you hold for the long term. But you are operating on human timescales, while the infrastructure operates on microseconds. If you feel like the game has changed without anyone sending you the new rulebook, you are right. This isn't a failure of your strategy. It is a failure of market structure. The algorithms are already here. They control the majority of trading volume in major markets. They provide liquidity under normal conditions, but can vanish during stress. Understanding these dynamics does not eliminate your exposure, but it gives you better questions to ask and better signals to monitor. In the next video, I will show you why Wall Street's most profitable AI strategies are fundamentally unexplainable. When algorithms make billions but cannot tell you why, what does that mean for market stability? Subscribe to see what happens when profit and explanation diverge.